Hey everyone, I'm Ray Hoyle, and I'm here today with my friend Joe Helms, and we're going to talk about the extra option people have when trying to finance a home. It's new, but it's a new old, and it's not for everyone. It's an extra thing I have in my arsenal to use for people who have the golden handcuffs. They want to move, but they have that great interest rate and they don't want to let it go. Joe is our answer, and may not be for you, but if you're open-minded to hear what he has to say, I'm here to present him to you, and it's just a great option to have.
Yeah. So let's just go ahead and jump in and say what I'm about to show you and what I'm about to explain to you can absolutely change your life. It can change your financial life at least. But you are correct to be. I want you to be skeptical. Listen, if anything sounds too good to be true, it probably is, and all that stuff. I want you to kind of come in with that mentality. But I don't want you to come in with like a closed-minded mentality, because then it doesn't matter what I say, you're just not going to buy it. Be skeptical. Be skeptical, because what we're going to go over, it's just math. It's not magic, anything like that. So what Ray was just, what she just put into place, and what she's describing is like, okay, so you've got people that have been in their homes and they got that magical rate, right? Like the 2.5s and the 3 points, whatever. However low your rate is.
Joe, they really want to move.
I know, but you can't, because why? The elephant in the room is rates. The rates are too high. So, point number one, Ray, why is interest rates on a mortgage so important?
Because it tells you your monthly payment, what to expect, and it gives people a sense of security in knowing what to expect every month.
Yep. Yeah, so what we're going to be going over, I just want you to know, I really don't care what your rate is. If you want to keep it, if you want to keep that 2 point whatever for the next 25 years, be my guest. But I'll tell you right now, my average client pays off a 30-year mortgage in 5 to 7 years on their current income, with their current lifestyle. We're not talking about red beans and rice. We're not talking about living like nobody else. You can live like nobody else when you're 79 years old, okay? We're talking about a smarter way to finance.
And Joe, I mean, it's great that if some people want to pay it off in 5 to 7 years, and they can be absolutely frugal to it. This loan has opened up me, my friends, my family's minds to being able to access the equity that our biggest asset has gained over the past 5 to 10 years, which is our homes. Right now, some of us are sitting on $300,000 in equity, and we can't touch it.
Yeah.
It's great we have a great interest rate. That's about it. So Joe's given us another answer. And whether you want to pay it off fast or you just want access to that money and also pay off your debt fast too, I think this is just, it opens up a lot of different options.
Yeah. What we're going to go over is a debt crushing machine. Whether it's your house or your cars or your pool or credit card bills or whatever you got, it's a debt crushing machine. But we'll use the house as the example, and we can, if this interests you, we can have a one-on-one and see how else how else it would be a benefit for you as well. So what Ray just said is exactly right. So interest rate with a mortgage is super important, because interest rate for a mortgage dictates your monthly payment, right? Lower the interest rate, lower the monthly payment. That's simple. But when it comes to how much interest you're actually paying, it has relatively little to do with that. So that 3 or 4% interest rate you're sitting on, congratulations, you're paying 65% on your money every month. And I know everybody's like, well, that's over the lifetime of the loan. Yeah, it's still bad. Like, that's still really bad. You'll have a low payment, but of that low payment, 60% of it is going straight to interest. It makes a credit card look great. So that's because of the type of interest that it uses. And a mortgage uses compound interest rate. What we're going to talk about today is a simple interest rate. By the way, we're not going to get into like super the weeds of this stuff. we're going to give you the simple explanation of how it works. And if you're looking to buy a house, this is a fantastic way. You need to reach out to Ray, and so she can kind of walk you through that process, and I can see if this is going to be the right type of financing for you. So a little bit of background on myself. My name is Joe Helms. I'm a licensed loan officer with University Bank. We're based out of Ann Arbor, Michigan.
Go Blue.
I am local though, here in Fort Mill, South Carolina. So I do work remote. Now, we're a regular bank, guys. Like we focus on checking accounts, savings accounts, mortgages, all that stuff. Now, the lending arm of the bank that I work for is called University Lending Group, okay? We have 12, 13 branches of that. And now all of those focus pretty much exclusively on mortgages. I'm based out of a branch in Hendersonville, Tennessee, where we focus on what's called the SMART loan, okay? And what this is a first lien HELOC. Now I know as soon as I say the word HELOC, a lot of you are jumping out, I already have a HELOC or variable rate mortgage or variable rate and all that stuff. I get it. I get it. That's not what we're talking about. We're not talking about that. We're talking about a first lien HELOC, not a second lien like a lot of you watching this video already have, okay? Not talking about that. It's gonna be a little bit different. So if you wanna look up, hey, is this serious? Is this legit? All that stuff, great, do it. Look up the name of my bank, look up my profile, look at all that stuff. You can see testimonials on people that I've helped. I've actually helped Ray. And so you can absolutely look that up. Now, you brought up something earlier, just kind of reiterate that, this whole golden handcuffs.
Well, I hear from neighbors, friends, family every day, like, hey Ray, I like my house. I don't love my house. I really would like to get a basement. I really would like to do something different. I really want to add a pool, but I can't change my house because I have a really low interest rate and I just can't afford to get out of it.
Yeah.
And so people don't make decisions to move and don't do anything because of those interest rates. Those are holding everybody back right now.
Yeah. Yeah.
Because they're high if they want to get a new one. This, in a sense, removes the golden handcuffs.
Absolutely. Because when it comes to a mortgage, interest rate's very important, just like we were saying before, because it dictates monthly payment. But when it comes to a first lien HELOC, time and balance are more important than rate. And if that doesn't make sense, that's okay. We can dive into that. But what I mean by that is this. Just take this example, for instance. If you have a 3% interest rate on a 30-year mortgage versus a, say, 6% interest rate on a 10-year mortgage, which one do you actually pay more interest on? It's the 10-year. And it's not even close. Even though you've doubled the rate, the amount of interest that you paid was significantly less because you affected the time and the balance. And when I say my average client pays off a 30-year house in 5 to 7 years without changing anything about their income or their lifestyle, that's a huge win. My average client pays off 40 grand a year, like I said, without changing anything. And overall life of the loan, typically it's gonna save around $150,000 to $200,000 of interest. $150,000 to $200,000 of interest.
But Joe, this isn't just going to be for anybody. Not everyone can qualify for this. It takes a very specific person.
Yep.
So, you have to be well qualified.
Yeah.
With meeting a lot of standards.
Yeah, and so like your first-time home buyers and stuff like that, for the vast majority of you guys, we're not ready. We're not ready. I can teach you how it works, but you're not going to be ready to pull the trigger on something like this. This is going to be for your people who have been in the same house for the past 5-6 years. You've gained a lot of equity in the house. You'd like to move, but you like we were talking about, the rate's so low. It's like you don't want to take on that higher payment and all that stuff. So this is going to be for you because it's really going to erase all that stuff. So I want you to look at it like this. I'll just to give you an example of how this works. Right now, you have a mortgage, you have a checking account, you've got just regular banking stuff, right? Like all of your money goes to the checking account, you live your life, you pay your bills. I'm gonna take away the one component that makes this impossible for you to do right now. If you on your mortgage right now could put money in and take money out, changes the game, and you're already doing what we're talking about. Because what that would allow you to do is it would allow you to put all of your money onto the principal balance of your house, but when you need to live life and pay bills, you can just take it right back out. Therefore, you're giving every single dollar a job. You're helping it press down a debt, and every dollar's working for you. But you can't do that with a mortgage because it's a closed-in loan. But if it wasn't though, you would already be doing that. And that's what you're gonna be able to achieve with this. So when I say like rate doesn't matter, it matters a little. It's third place. It's third place. You know, what is it? 2 is not a winner and 3 nobody remembers. A little Nelly quote out there. But so that's really how this works. It works like it's an open-ended mortgage if that's the easiest way for you to understand. But that's the end goal. Like if you could put all your money onto the principal balance of your mortgage right now and pull money back out when you need to live life and pay bills, you would get your house paid off in about 5 to 7 years. And that's why it works. That's why it works so well. So, you know, I was talking to somebody earlier, and I brought up the idea because they were just hung up on mortgage, and I brought up the idea of a 4% interest rate. And I said, right now, if you could offer a 4% rate, you would get every single deal in town, in the whole state. People would be lining up for miles to get that. And what they would be lining up for, say the house was $700,000, what they would be lining up for is a monthly P&I payment of over $3,300. And in the first 84 months, they would have paid around $280,000 total. So 6.5, 7 years, around $280,000 total. They would have paid over around $180,000 in interest, and they wouldn't even have cracked 6 figures on the principal balance of their home.
So who gets all that money, Joe?
The bank. The bank does. And I'm not over here saying the bank still doesn't make money, even on what I'm talking about. But I'm saying as far as a financing tool, man, it's not even close. So if you want to know more about how this could work and how it could work for you, how this works, how it could work for you, I want you to talk to Ray. As you know, hey Ray, I've been looking to buy a new house for a long time now. I've been stuck in my 2.5% interest rate, and I just don't see a way where we can move. Our family's growing. You know, we need to move mom in with us, but we can't because we have this. Like, if that's you just want to move, get it, Ray. We can connect on this thing, see if it's a good fit for you.
And it sounds great for refinancing as well, but also it works just like a conventional loan when we go to purchase a new house.
Yep.
So it's pretty simple. It's a very simple process in comparison to any other loan that we've done, if not smoother.
Yeah, I mean, when it comes to like all that stuff, we can get into it later, but it's an easier process, just to break it down. So if that would be a benefit for you, and you know, if you're serious about like, hey, I would love to get my house paid off. Hey, I would love to get my cars, my credit cards, my student loans, my all these things. If that sounds good for you,
you can pay it all off and get a new house.
Yeah, it's pretty sweet. So hey, get at her. We'll talk about it. Take care. God bless.
Thank you.